Profit margin is a key financial metric that shows how much of a company's revenue turns into profit. It's expressed as a percentage and indicates the efficiency of a business in managing its costs and generating earnings. Higher profit margins mean a company is more profitable and efficient. What is profit margin? Profit margin measures the proportion of income left after expenses. It helps businesses understand how well they're controlling costs and turning revenue into profit. Types of profit margin. Grossprofitmargin shows profit after subtracting the cost of goods sold (COGS). Formula: gross profit divided by revenue times 100. Example: if revenue is $1,000 and COGS is $600, gross profit margin is 40%, $400 divided by $1,000. Operating profit margin includes operating expenses like wages and rent, but excludes taxes and interest. Formula: operating profit divided by revenue times 100. Net profit margin represents the final profit after all expenses, taxes, and interest. Formula: net profit divided by revenue times 100. Example: if revenue is $1,000 and net profit is $200, the net profit margin is 20%. Why is profit margin important? Measures efficiency. It shows how well a company manages costs relative to its revenue. Financial health indicator. High margins indicate a healthy, profitable business, while low margins suggest room for improvement. Industry comparison. Margins vary by industry, so comparing them helps gauge competitive performance. Guides pricing strategy. Understanding margins helps businesses set prices that maintain profitability. Real-life example of profit margin. Imagine a coffee shop that earns $10,000 in revenue. After subtracting $6,000 in expenses, the net profit is $4,000. Net profit margin equals $4,000 divided by $10,000 times 100 equals 40%. This means the shop keeps 40 cents of every dollar earned as profit. Factors affecting profit margin. Cost control. Reducing costs like raw materials or labor increases margins. Pricing. Higher prices can improve margins, but only if customers are willing to pay. Sales volume. Increasing revenue while maintaining fixed costs boosts margins. Industry dynamics. Some industries, like software, typically have higher margins than others, like retail. Quick recap. What is it? Profit margin shows how much of revenue becomes profit, expressed as a percentage. Types: gross, operating, and net profit margins. Why is it important? It measures efficiency, financial health, and guides pricing decisions. Profit margin is a critical indicator for businesses to track profitability, control costs, and stay competitive in their industry.